Hi, welcome everybody to Outstanding Ohio's Education Event of the Month. This month we are talking about home mortgages and how to afford a house, how to know how much you need to afford a house. And with me today is my friend Christi.Nichols. She is with Ruoff Mortgage. She's a senior loan officer. She's been with them for 3 years. She works out of the Stowe office, but she can service loans anywhere in Ohio. So she's going to share with us a lot of good details today on mortgages. If you have any questions, feel free to throw them in the chat, or we should have plenty of time at the end as well. So let me share screen here. And let me just get things arranged.
Sure.
Our faces out of the way. Always something. Let's see. Let's try that. Okay. I have to. Okay, so here we go. So the first thing is, what do you need to provide to be pre-approved? And on that note, also the difference between pre-qualification and pre-approval. So kind of the first step to the loan process.
It really is. So thanks for having me, Erin. I appreciate you doing
course.
this. It's my first webinar, so I've never really done anything like this before.
Yay.
So I appreciate your help in getting it set up. So buying a house, yes, this is the first step to buying a house. And right now we do have a lot of pre-approved buyers and not very many houses in the inventory. So we're hoping we get some more houses listed. It's a good time to sell your home. It really is. So the buyers' first step is they're going to want to get pre-approved. Okay, there is a difference between the pre-qualification and the pre-approval, and you can see that here. The pre-qualification letter is just a document from the lender stating that they are tentatively willing to give this person a loan for a certain amount, whereas a pre-approval requires verification. So that's my job as a loan officer. I'm going to verify someone's credit score, their identification, their income, and their assets, and that's going to go to their ability to repay. So that when they do go out and they find a home that they love and they're making an offer on the home, they have a pre-approval letter from a reputable lender who's going to come out and say, yes, we've gone through all the verification documents. This should be good to go. So that's step one, so that your realtor, yourself, the seller, their dogs and cats, everyone's not inconvenienced if you're not pre-approved to buy the home yet. So that's the goal, is to make sure that that is, a pretty solid deal as we go in. Because the last thing you want to happen is for your loan to fall through an underwriting. That's a heartbreak for everyone involved. So that's what we want to try to avoid. And there are federal guidelines that we have to verify and confirm to make sure that that application is a good one. And when you ask what you need for pre-approval, I have it listed out like this. And if you'll forgive the use of the misspelling of the word pencil, this is sort of what we need from what we're looking from everyone when they're going to get a loan. So it's called a uniform residential loan application. It's also called a 1003. And the items below are what we're looking for. What's the property address they're looking at? What's the estimated value of that property? What's the name of the borrower? This is what we're verifying, their identification. Their social security number, so we can pull their credit report. This credit report is going to make sure that there's no liens or judgments out there on this buyer. And also going to make sure that our credit score meets our minimums. And it's going to help determine where their interest rate is going to come in too when they, do make an offer on a house and lock in their rate. We're verifying their income and we're verifying their assets. So to do this, we're gathering some pay stubs and W-2s up front, bank statements to verify the assets. And then once we go in and we have an offer accepted on the home and it gets put into underwriting, we've got all our ducks in a row and we're ready to get that through underwriting just as quickly as possible. Underwriters, they will verify all the information again. And again, we want it to be a pre-approval so that there's very little chance or risk of this falling through.
So some people might be thinking, well, how could I get pre-approved before I start looking for, like, I don't know the property address before I start looking.
We're going to
So
put in a to be determined at that point. So a TBD is what the address would be at that point. But if we do have a house that we're interested in, we can start putting together monthly payments and really give an idea of what that house would cost them, because we're approving them essentially for a monthly payment, not necessarily for the price of the home, because the home itself, minus the down payment, that all comes into play. And there's several layers to this onion where we want to make sure their credit scores where they need to be. They do have the ATR, or ability to repay, but also we'll, see that we have our what's called debt to income ratio, or also DTI, isn't over half their pay going towards this house. So we want to make sure that this is good for the borrower, the consumer, the buyer, and everyone involved.
Yeah. Is there like a bare minimum credit score that you need to have to get any kind of loan? I don't know if that's a
Yeah,
loaded
so
question.
it is, because it depends, every one of these are dependent on the person's or the buyer's individual file, their individual profile. It's going to be based on, are we going FHA? Are we going conventional? How much are we putting down? How much do we have available to put down? And so on. But a minimum credit score, we're looking at 580, 600 for federal guidelines to go FHA. And then
Okay.
we're looking at 650 to 680 or better for a conventional loan.
Okay. Good to know. All right. And that's, in this market especially, it's so important to get that pre-approval up front, because you could go see a house and their offer deadline could literally be like hours away. Like, okay, we saw the house at 2, we have to get the offer in by 5. We don't want to be scrambling trying to get you pre-approved. I mean, you could do it, but I'm sure Christy would prefer that you call her up front and get the pre-approval. And then we know for sure that you can afford the price of the house that we're looking at, and then you're ready to make that offer so you don't miss out on it.
Sure, that's the preference, is to get this done in advance and have all those documents ready. But it is something that can be done on the fly. If your buyer does have access to the documents, and I can confirm that quickly, then it's something that can be done same day, same hour in some cases.
Yeah. Okay, so this is a great chart you put together on the different types of loans. Can you kind of go over high level, like what, how much do you need for down payment, and what is mortgage insurance, and kind of give us the lowdown of the different types of loans that are out there?
Sure, and this is just going to be kind of a surface explanation of each type of loan and loan option to see which one you qualify for and which one is best for you as a buyer. So USDA, this can be a great loan for those buying in more of an agricultural area, not outside the city. There is a list online at the USDA.com or .org that you go in and you put in the address and see if this is eligible for USDA. And again, that's going to be outside city limits. It's going to be an area that could, in fact, be an agricultural plot of land. So that's where that would come in. It's an option. We've got the VA loan, 0 down. In this case, there's not going to be monthly mortgage insurance. And that monthly mortgage insurance is another question you're asking about. PMI is what it used to be called, or monthly mortgage insurance is the same thing. On a conventional loan, which is further down the list here, that's going to be anytime you put down less than 20%. So anytime you're putting down less than 20% on the home, you're going to have a small amount that you pay per year until that does get to that 80% loan amount, where you've paid the loan down to where it would have been if you would have put that 20% down. So if you have 20% down on a conventional loan, you're not going to have any PMI or mortgage insurance. But you can put as little down as 3%, 5%, depending on the different loan products, and still have mortgage insurance. Whereas an FHA loan, yes, you can put down 3.5%. You can ask for some seller contributions, or what's called seller concessions, or closing costs concessions. And you are going to have a monthly mortgage insurance for the life of that loan, an FHA loan. Okay, so there's several differences between FHA and conventional, and it's not necessarily all based on someone's credit score. Some could be based on their debt to income ratio, where we talked about, where FHA allows us to go a little higher, conventional wants us to keep it, under that 50%. So there's several reasons you would work with a lender to decide which of these loans is best for you. Down to the OFA, which is the Ohio Housing Finance Agency. There's also a Community First grant. These are grants that would help toward the interest rate, toward the down payment, toward the closing costs on a house. So if you qualify for some of these programs, we certainly present them as an option for you and let you know what you're qualified for.
Yeah, so I think some of the takeaways here is people think that, I think there's still a misnomer that you have to have 20% down payment to buy a house, and that's really not true. I mean, there's literally options for zero down if you qualify for, and those are kind of more specific situations. But with even a standard conventional loan or an FHA, it can be 3.5%, or 5%.
Yes.
So you definitely don't have to have the 20%. On the flip side, you're likely going to have to pay some kind of monthly mortgage insurance for at least a period of time to kind of offset that. But it's like, could be $80 a month, something like that. And then this column about the seller contribution, or 20. Yeah.
Mm-hmm. Yeah, you never know.
Yeah. And then the seller contributions is where you're asking the seller to pay some of your closing costs, which in this market still a little tricky to do, because if there's, 10 offers and the other people aren't asking for the seller to pay some of the closing costs, that could put you at a disadvantage. So although it is an option, I just need to throw it out there that you need to, discuss with your realtor whether that's gonna, be looked upon favorably or not, as far as your ability to get your offer accepted. But there is a cap on how much you can ask for, depending on the type of loan, as a percentage of the sales price. So just something to keep in mind. But there's a lot of different things, and there's even more programs than what are on this sheet. But that's what, Christi, well, you don't have to worry about understanding all of this. You go to her and give her your situation, and she'll help you understand what the best options, or what some of the top 2 ones are, and pros and cons, and how they would work for you. So, but that's just some of the takeaways we wanted people to understand about down payment, how mortgage insurance works, and the seller contribution. So great.
Right. Another thing
ahead.
I hope you take away from this chart is, it is just a general overview of how these loans work and what the parameters are for each. So every buyer is different. Every buyer is different. Every credit score is different. Everyone's situation is different. Length of time on the job. So something to keep in mind, you want to work really closely with a lender who you feel comfortable, sharing all the information with, and you feel is educating you as well. So I like to make sure that, and it's not just me, it's our licensing as loan officers to make sure our customer, our buyer, our borrower understands the terms of the loan that is being offered. So I really try to, really make sure that I'm educating my buyers so they can make the best decision for themselves, instead of just handing it over to a lender and hoping they, make good decisions for them. I mean, I do, but I make sure my borrower understands exactly what the terms of the loans are. And, we're talking about, loans here. There are several options on loans too. There's 10-year, 15-year, 20-year, 30-year fixed rate. There's adjustable loans out there too. So these are some of the options that are available. And a good loan officer is really going to give you all of your options and really walk you through the whole process. I know that it's dry as toast. And I always make this joke that I'm probably not the most exciting person to talk to at the New Year's Eve party or whatever it may be. But when you're ready to buy a house, I got all your information for you. I'm very passionate about my job, and I wanted to understand what was happening when I buy my home. So doesn't someone else? It shouldn't be a mystery. You shouldn't wonder what's going on with your loan. You should really have someone who's letting you know every step of the way what's happening now, what to expect next.
Yeah. A couple other thoughts to throw out there is, you are providing a lot of information to the loan officer, but the realtor doesn't see any of that. So if you're like, oh, I don't, the realtor is my friend or my cousin or something, and I don't want them to see, it's all we know is you are pre-approved for X amount.
Yeah.
Based on a certain amount of down payment.
Again, licensing requires that we keep that information confidential, and so it's between the lender and your buyer, what their situation is, and why a loan product would work. This one would work better for them over another.
Yeah. And then the other thing I'll throw out there is that most times I think people get pre-approved or can be pre-approved for way more than maybe they're comfortable with or that they should be. So just because you could get pre-approved for a $500,000 house, you got to make sure you know your budget and realize like what that's actually going to cost you. Doesn't mean you should run out and get it. Maybe 350 is better for you or whatever. So it's, it's maybe not always the best idea to go all the way up to the max of what you can get pre-approved for. You might get yourself into trouble. So just throwing that out there.
Absolutely.
Okay. So
good loan officer is going to ask you.
Can I ask a question?
Yes.
Yes.
Oh, okay. And I actually posed this question to Erin a while back. I had a client who was looking for housing. However, they were concerned about, with the competitiveness of the housing market, that if they got pre-approved and they weren't able to find something that they wanted within that pre-approval range, that their credit score would actually take a hit. Therefore, getting pre-approved would be difficult for them. Can you speak on that at all?
Sure. Of
Yeah, great
course.
question. Yeah.
Yeah, really good question. So when you get pre-approved with a lender, they're going to pull your credit. Even if you're going with 3 different lenders and you're trying to decide which one of those lenders you are most comfortable working with, or has, the most competitive closing costs or that sort of thing, you're going to be having them run your credit each of those times. But do keep in mind that that credit report is good for 120 days. Okay. The pre-approval is usually good for 60 days. And it'll say that on the letter, the pre-approval letter, at least from me. And that's good for 60 days. In that time, when we're approaching that 60-day period, we still have 120 days, or still have days left on the credit report. It can be run 120 days each time. So that does allow for a little bit more time before we run our credit score. But your question of what it does to their credit. So when your credit gets run, it is going to ding your credit score 5 points, 10 points. And if you're having it run by several different lenders for the same purpose, then it all consolidates the following month. So let's say lender A, lender B, lender C, all 3 run your credit report to determine, what your situation is and what loan works best for you or that you qualify for. Anything run within 45 days consolidates the following month when it's run for the same purpose. So I hope that helps, clear that up there.
So you don't get dinged 5 points for each of them. You get dinged 5 points total. Or you may get dinged 5 points for each, but it would go back up once they realize that.
Yeah, it does consolidate the following month. Anytime it's run for the same purposes in that 45-day period.
Okay. And then 120 days later, if you have to run it again, they would get dinged another 5 or 10 points.
And it would again consolidate because it's for the same purpose. So
consolidate from the previous 120-day one, or if it's with.
Well, I don't work for the credit, reporting companies, Experian, Equifax, but from what I understand, this is something that just consolidates after 45 days. So if we're running it for the same purpose, these all consolidate.
Okay. Okay. Does that answer your question, Lisa?
That was a wonderful explanation. Thank you so much. And Erin actually answered the question a little bit more generally when I had previously asked. And unfortunately, this person just wasn't open to hearing that. They just understood that their credit score would keep going down. And that was the thing that they wanted to fixate on, as opposed to, well, maybe you could find a house in 120 days,
Right.
It's the perfect question. I get that question every day from every single buyer that I talk to because they're nervous. They don't want their credit score. We've all purchased a car, right? And we know that our credit score got run 16 times for the one car. And that's, makes you feel like panicking. But the following month that consolidates because they were all for the same purpose. So it's going to be the same type of situation for a home loan. So, the credit score is a big factor in determining the person's, options for loans, as you can see here, and where the interest rate's going to fall.
Mm-hmm. Yeah. Yeah, it's a big deal. Okay, thank you. Okay, so the question on everybody's mind, and I'm sure you get it like a million times a day, how are the rates? What's going on with the rates?
So let's have a look at this chart just to sort of illustrate where the rates are. Okay, we're going to go all the way to the end. We're in 2023. So our rates are going to be somewhere where they were right in the 2005, 2006, 7 range here. So you can see, because it's compared to 2020, those were historic lows. We would all love to see those again. The whole entire history of the market here in our country is laid out in front of us here. And so we've got the unbelievably low rates of 2.5% in 2020. Those were incredible. Folks who bought a house in 2020, 2021, refinanced their house in 2020, 2021 are sitting on 2.5%, 3% for their mortgage loan. That is absolutely amazing. If we could get it, we want it, right? We'd all love to see them go down again. But where we are is somewhere back in this middle range. You can see, all the way back to where it was up at 10%, 12%, 15% and higher. We're nowhere near those situations now. We're all the way back over here. And again, if we're comparing it to what happened, during the COVID crises in our country and the whole world, it's hardly something we can compare it to. We'd all love those rates back again, but maybe not the circumstances in which we got them. So
Yeah.
you can see where the rates actually lie now. We're in the low sixes, is where we are today. And that could change tomorrow. That could change the next day. It could go higher, it could go lower. All lenders are seeing the same rates. So when you have someone calling around saying, I want to search for a rate, you want to make sure you're understanding that lenders, we all see the same rates. So you're not necessarily searching for a rate, you're searching for a lender who's going to be helpful to you, walk you through the process, really do their job, be as passionate about getting you into a home as you are, and also help you understand where the real savings come in. Yes, it's about rates, because an interest rate is what a bank will charge you to loan you this money. However, if you're looking at closing costs, which is really the question we should be asking our lender, is what are your closing costs? What's your lender fee? Okay, because at this time of the market, I'm recommending to folks to just accept the rate as it is today, because it's really, let's look at it in the course of 100 years here, we are well in the middle range. This isn't necessarily out of control. It just seems so, because again, we're comparing it to 2020 and 2021. This is really pretty normal in the course of our interest rates. So we want to make sure that our rate isn't too high, but we also don't want to spend a bunch of money up front buying down rates or discount points or origination points. And that's where the fees start piling up, and it really has your closing costs out of control once we get there. And there's a difference between closing costs and down payments. We'll talk about that. But the question, sure, it's the rate, but do keep in mind it's controlled by the market, our actual market out there, and so we're watching the market, and all lenders are seeing the same rates. It's a matter of what the lender's charging you to get that rate, how long it's locked, and several other pieces of information that I really want to get out there and let people know. This industry has left our realtors even in the dark, so for so long, realtors had to count on their lender to let them know why and where and what's happening with that. And it shouldn't be a mystery. This should be very transparent, and that all of that should be, upfront and explained to the buyer and borrower right away.
Yeah. And they don't get their actual rate until they are under contract and put in their official loan application. Is that right?
In my opinion, that's the right way to do it, until we have an actual address. However, there are some lenders out there will do something called like a lock and shop. They'll lock you in at pre-approval, and they'll say, today's rate is 6.125. We're going to lock you in at 6% or 6.125. And you get to go out and then shop from that point. The problem is you're getting charged to lock the rate for a longer period of time. So when the accepted contract comes in, the right way to do it, in my opinion, is to lock it at that time. We do have 3 to 5 business days per the contract to make a decision on, who we're going to choose as a lender. And at that time is when you do want to compare some rates. And you're going to see that most lenders are giving you the same rate. It's just a matter of what they're going to charge you to get the rate.
Right.
When you wait until you have an accepted contract, you get a free rate lock for 35 days. There's no reason to pay for 55 or 80 days or 180 days, and again, this is some of the mystery that I'd like to, I'd like to open the curtains and show you how this is all, how it boils down, and just really walk you through it. That's my job.
Yeah, that's perfect. Okay, so next we had, so how much does that mean, from a monthly standpoint? How do you figure out what your monthly expenses are going to be?
Yeah, so we have a very, unexciting chart here, but this is going to break down what a $200,000 home might be if we took even on the high end of what the rates are today. Okay, so actually you'd see a lower 6s today, but we're going on the high end. Let's say our borrower has a lower score. Let's say they're only able to put down 3 or 5%, which is great. You don't have to put the 20% down we talked about for a conventional loan. So here's what we're looking at now. This is a case study for $200,000 home, 5% down payment. And we can talk about down payments too, where they come from, all sorts of information here. So your loan officer has verified that they can in fact afford a $10,000 down payment, whether it's coming in the form of a gift or they already have it in the bank. And so our loan amount is $190,000. You can see the difference there. And then we're going on the high end of what an interest rate might be for someone today. Let's say it's 6.875, 30-year fixed loan, 360 months. And then the payment and how it breaks down. So on the left, you'll see monthly payment of $1,248.16. On the right, we're looking at the whole picture. All right. So now we have the proposed monthly payment of $1,248. That's the principal and interest if this were your loan. Then you're going to add in homeowners insurance. Okay. The buyer, when they get that accepted offer, can call up their agent and say, hey, agent, I have an accepted offer at 123 Main Street in wherever. Can you give me what my quote would be? They would work with their agent on the cost to rebuild. They'd work with their agent on what they want their deductible to be. So let's say our payment came in at $85 a month. Okay, so we have a payment here. Then let's talk about property taxes. Okay, depending on where you're buying a home, if you're buying a home in Hudson, your property taxes are going to be $600 a month. Okay, if you're buying a home, in certain parts of Cuyahoga Falls or, North Hill or, just the areas around here, even Stowe, you're going to be looking at in, Fairlawn, Copley, these are going to be $250, $300, and this all depends on the actual home itself, the actual property, and it's all found on the auditor's site for your county. So I'd go to the Summit County auditor's site and I'd confirm, in fact, that is the property taxes, put that in there. And in this case, mortgage insurance was only $27.50 per month. And so that's what they're going to be paying now until it does get to the 20% or 80% if you had put 20% down up front. That will fall off when we do get down to that 80%.
I think I was thinking about the homeowners insurance when I said $80. Yeah.
Yeah, no
20
worries.
or 30. Yeah.
Yeah. So let's say we throw some darts at, what that would be. Of course, we would confirm these numbers, and we'd firm them all up with our insurance agent and the county auditor and so on. But our payment, $1,600. So you just bought a $200,000 home and your payment is $1,600, whereas most renters are paying, 15, 16, 17 and more per month to rent a home, so all of that included is still, pretty good numbers compared to renting right now.
Right. And, the mortgage insurance could go away if you get to the 20, your payment could go down if you refinance at some point, if the rates go down and so forth. But yeah, I always want to make sure the buyers understand it's not just the mortgage, that there's those other pieces that go into their monthly payment. And then of course you're going to have utilities and like home upkeep and things like that on top of that. So,
can I throw in here also, Erin, if you're looking at this, it says 360 months, that's a 30-year fixed rate. Can we talk about that really quick?
Yeah.
So when you get a 30-year fixed rate, even today, okay, and you say, okay, this isn't the ideal interest rate. We're obviously going to date this rate. We're going to marry the house. Okay. We love this house. We're just sort of dating this rate. But then you ask, wait, I'm stuck in it for 30 years, right? You are not. 30-year fixed rate means the lender, the bank, can't change those terms on you. They are fixed in place. And at no time can they change those on you for a 30-year fixed rate. You, the buyer, the borrower, the homeowner, have the option to refinance when the rates go down. Okay, so if you're working with a good lender, they're going to reach out to you and they're going to say, hey, Lisa, let's get you out of this 6.875. It's, we're at 4.99 today. These are really good rates. You want to refi? And we talk through how this is going to look, what we need to do to refi and get you out of it. So the borrower is really, the buyer is always the one that's holding the cards, and as long as they're rather their credit scores where it needs to be, they still have the income, nothing has changed in their situation, then we can refinance them into the lower rate. Fixed, again, means the bank, the lender, can't change that on you. You, as the buyer and the owner of the home, can change your terms and your rates at any time as long as you meet all the qualifications.
To refinance, yeah. Yeah,
Same
that's a
goes
good
for
point.
Same goes for FHA. If you go into it with an FHA loan and that's how you bought the house, you can still get out of that FHA loan if your credit score is a bit higher or the situation has changed, and you can refinance that. And you'd want to wait 7 to 12 months to do that, and there's reasons for that. But in 12 months, 18 months, we could be dealing with much lower interest rates. A lot of times it's around situations in the world, it's around the election cycle. We really don't get to know, but historically that's been the case.
Right. And then this is just the same example, but with 20% down instead. So your payment's going to be lower. You're at 1,051, and then you have no mortgage insurance. So for the same price of house, your payment, your monthly payment, if you will, could be anywhere from like 1,300 to 1,600 because of those variables. But you're putting 40,000 down up front instead of 10. So
these numbers might surprise people to say, wait, if I put 40 grand down, it's really only changing my monthly payment by less than $300. Yes.
Right. Yeah.
So this is where the real, information that the lender is getting and talking through with their buyer comes in. Do you want this lower payment, and to make sure you're putting this in up front? It's going to take away our mortgage insurance, which was only $20 some, if you recall,
right,
from the previous page. Or do you want to hang on to some of your own funds as you go in? You may want to update the home, so these options are something your lender needs to be showing you. If you qualify for a 15-year rate, 20, 25 instead, even adjustables, we can go over all of those with the buyer. And then the buyer has the choice to make that final lock when we get that accepted offer.
right. I think what I'm learning is there's a lot of trade-off decisions of like, the money up front versus the monthly payment, like just having to think through what the kind of return on that and upfront investment is, depending on how long you're going to be in the house. And like, there's just a lot of variables, and Christi can help you sort through all of that. Okay. So how much, that's kind of what you're paying, like down payment, what you're paying, on a monthly basis. But then there's this thing called closing costs that I always am nervous. Like, does the buyer understand how much money they're going to need to bring to the closing table to make this happen, in addition to the down payment, because there's other costs associated with the transaction, if you will. So can you walk us through that?
Absolutely. So this is huge. Okay. And when we talk about going out and talking to different lenders and interviewing lenders and deciding who you want to work with as a buyer, you want a lender who's going to be extremely transparent with you on this here, especially the number one thing, the lender fee. Okay. So that's not a fee that's necessarily regulated. It can be anywhere from $1,250 to $7,700. These can all change based on the lender itself, what they charge for their lender fee to do the underwriting and the processing. Some may say, oh, we're going to waive it all together, but then you'll find discount points and origination fees in there that you didn't expect. And that's to get your rate where it needs to be. For my case, the reason I work for Ruoff Mortgage is because our lender fees are super transparent, and I've never felt comfortable trying to sell someone a bill of goods that isn't exact, so I'm able to give an actual upfront number. Separate from the down payment are the closing costs, and here's how they go. Lender fee here at Ruoff Mortgage is going to be somewhere between that $1,250 and $1,400, depending on if you're going to go with an FHA loan, depending if you're going to have a conventional loan. There's several, different loans that we discussed. So let's say that we're, looking at this $1,250 for an FHA loan. And again, at this time, I don't recommend buy downs. I don't recommend discount points, only if the buyer is asking me, I want to be at 6%. I want to be at 5%. Lenders can kind of get you wherever you want to be. They just have to charge you for it. So you have to ask, what am I? There's nothing free in the world. We all know that. No free lunch and such. So let's ask the right questions, which is, what is your lender fee? So here at Ruoff, we have it. It's transparent. We tell you straight up front. Then let's look at the appraisal. Okay. The appraiser is different than the inspector. The appraiser is going to go out and make sure that the house you're buying is worth what you're buying that house for in that neighborhood. They're also going to check for sanitary, safety, structural issues while they're out there. An appraisal fee that comes in, right around $500. Could be $420, could be $520. It depends on the appraiser. Then we've got your title fees. This is really, really important and not something that's optional. This is something that is the legal entity of this whole process. Okay, so the title fees are going to be about 1.5 in some cases of the purchase price. I see you've got different numbers here, so we usually don't see it go over that 2,500 range. So let's say you're buying a $140,000 home. A best guess would be $1,400 on that. But every title company is different. They do charge a little bit different of percentages at the title company, but it's all within regulated numbers that are out there. So the title fee, we have to know if your home that you're buying has any liens or judgments against it. You don't want to buy someone's child support also that they didn't pay 16 years ago. You just want this home. So we want to make sure it's a free and clear title. And we want to make sure that who is holding our money and dispersing it to the third parties is in fact, have all of our ducks in a row and everything's where it should be. So this number here, title insurance, is an estimate. Escrow, you've probably heard of escrow, and it's really just means we're going to hold some funds and pay to a third party later. Those third parties are your homeowner's insurance agent and the county for property taxes. Okay, so let's say we're going to close in May. So if we're closing this month in May, this county of Summit County doesn't collect until July, middle of July. So we're going to collect 2 months of homeowners insurance. Does that make sense? So
Property taxes.
Property taxes. Thank you. Collecting for property taxes May to July. So we really only have to collect a couple of months up front here. However, if we get past the July, we're going to go all the way to February when the county collects again. So that might be 7 months. That might be 8 months that we have to collect at that point. And the county kind of lets us know what those should be. But that can sometimes be a little confusing here. And that's an important thing to discuss, is how much the actual residential taxes are on the property and at what month it's closing. And should we be in July or should we be in February? When should we be collecting? So that's something your lender will work with you on to let you know exactly what your closing costs are going to be, or a real close estimate here. The homeowner's insurance, let's say you get a quote from your agent. The agent says it's going to be $85 a month. Well, we're going to take that times 12 months. We're going to collect at the closing, and then disperse to the agent his or her 12 months of insurance straight up front. So that gets dispersed immediately to the agent. But what's going to happen in May of 2024? That agent's going to have their hand out saying time to pay up for the 12 months. So we're collecting that as part of their monthly payment, as we saw before. Each month that gets collected and set into an escrow account. So the closing costs, you really should be able to get a pretty good idea of what your closing costs are up front. And you don't want a whole lot of hem-hawing around on that. You need to know what the closing costs are going to be. And you need to ask your lender, what are your lender fees? Are there buy downs? Are there discount points? Are there origination fees included here? And I need to know what those are going to be, as it is, the actual money you earned. You need to understand those up front. So I'm very, very careful about handing those out. And then lastly, each realtor charges an administration fee to, or each, brokerage does. And so it can be, $250, it could be $700. That's going to be something that's going to be in the contract from your realtor, and they'll let you know what that is straight up front as well.
So so that it adds up, right? So
It
that
does.
adds up to $5,700. This is, an estimate again for a $200,000 house. So that's another almost 3% that you're going to need to have funds available to pay at closing, in addition to your down payment. So with this example, if we did a 5% down payment, you're going to have to pay that $10,000 plus the $5,700 in closing costs. The minus here is the earnest money. When you go under contract, it's kind of standard in our area to offer earnest money of around 1% of the purchase price. So a $200,000 house might be $2,000. Those funds are due typically within like 24 to 48 hours of going under contract. And it's like good faith money that you're planning to move forward with that contract. that
Yes.
money goes towards your down payment. So so if you're saying you're putting down 10, it's like you're putting down 2 on day 1, and then you're putting down the other 8 on the day of closing. So, you could be, looking at having $14,000 due at closing. The only other transaction cost really that I can think of upfront is if you do an inspection, you will be responsible typically for paying the inspector, which could be $400,000 to $800,000, depending on if there's well, septic, size of house, that kind of stuff. So, you may have to pay, you're going to have to pay the earnest money upfront. And then shortly thereafter, in the first week, you're probably going to have to pay the inspector. And some lenders, I think, require the appraisal to be paid up front, or some kind of like lender fee of $500 or something up front. But the rest of it's all going to be due at closing. And just want to make sure people kind of understand that and plan for it and aren't surprised by that at the end. And the lenders should be giving you estimates along the way to kind of give you an idea and so forth. So
Yeah, great synopsis. That's all.
Yeah. And as you're getting your pre-approval, to ask for like, hey, can you estimate what my closing costs would be, given these types of scenarios, timelines and so forth, would, just a good idea to kind of know what you're in for. And then we talked a little bit about, you could try to ask the seller to pay for these. Now, mind you, the seller has even more than this in their own closing costs. So they're not going to be really like, yeah, I'd love to pay for yours too, when they have multiple offers. But if they don't have multiple offers, or you can make the offer in such a way that it's still attractive, even with asking them to pay for closing costs. But again, like Christi said, nothing's ever really free. So something to understand with asking the seller to pay your closing costs. Let's say that the list price is $200,000. And you say, I'm going to offer you $205,000, but I want you to pay $5,000 in closing costs. And that's maybe a bad example because that's more than you're allowed to ask for, but let's just go with the simple math here. So your mortgage is going to be now at $205,000. So it's basically like you're kind of rolling your closing costs into the mortgage, and your monthly payment's going to be a little bit higher because of that. Or on the reverse, even if you offer $200 but want $5,000 in closing costs, like you could have offered $995 or $195 and paid the closing costs up front, and you could have had a lower monthly payment. So you're not really getting it totally for free. Something to think about, and the seller has to think about it in terms of just what are they going to net, because they're not actually paying anything like out of their pocket. It's just that they're going to get less proceeds than they would have it at a higher price. So again, something you can talk through with your realtor. And then last but not least, and you covered this a little bit, we have this idea of marry the house, date the rate, and a lot of hope that at some point we can refinance into a lower rate. And just want to understand, what does that look like? What does it cost? You mentioned having to wait, ideally 7 to 12 months. How does that work? And then there's also something called recasting, that if you can cover that as well.
Sure. Let's start with the refinancing piece here. So what does it cost to refinance? When our rates go down, which they will, historically, we've seen this on the chart, and I say that with my fingers crossed also.
Yeah, sometime in the next 30 years, they're likely to dip at some point.
So when you see that your rates are going down, if you're working with a good lender, they're going to reach out to you too, like I said earlier, and they're going to, say, let's get you into this. We're at 4.125. We're 2 points lower than you locked it in at, or whatever that case may be. So here's where you're going to talk about, is it worth me locking in at a lower rate? Almost always the answer is going to be yes, when the rate is that much lower. But what does it cost to refinance? You'll have closing costs again. Okay. If you already have closing costs set up in escrow in your current mortgage, you will get that escrow money back. Okay. In fact, it'll come back to you within 2 weeks to 30 days of closing on your refi or your refinance. And it's usually going to come in a plain envelope, and it has been thrown away. So you always want to watch out for that. Your escrow is coming in the mail, but it comes back to you. It's your money. And we start again with a new escrow account. You're going to have your lender fee. So let's say we're at $1,250. We're going to refi. We've got a lender fee of $1,250. Again, I'm super transparent with that on what Ruoff charges. If it's conventional, you might see $1,400. You may even have a lender that's going to offer you some, better options if you're coming back to the same lender to, refinance. They want to keep your business, so they'll be offering you some, reasons to come back to them, some benefits there. The lender fee still going to be there, maybe a little less. Then you're going to have your title costs. Title, about half of what you originally did. We already know the survey of the property. We have already done the title work on this house, usually within the last, few years. And so that's going to be much less. Your appraisal costs, often waived, if we can get the appraisal waived. If not, we know the appraiser is going to go out and it's going to be $500 or $600. We talked about that earlier. The appraiser is climbing on the roof and checking the basement. They want to be paid for their work there. If they spend 2 or 5 hours out at this property, they will, want to be paid. So that's an important part of the process too. But again, if we can get that waived, great. Escrow, as I said, the money gets returned to you and you create a new escrow account. So again, we've got 12 months of insurance up front. So we're going to check in with the agent. We still good at $85 a month, and we'll collect that $1,040, let's say. And then again, what month were we refinancing in and when do we collect again? That's all going to come into play. So if we're refinancing in August, let's say, and then we don't collect again until February, we're going to have August, September, October, November, January, February. So we have 5 or 6 months to collect there as part of that refinance if we do it in August. So that's sort of where we are on the refinance. And if we put new numbers in and we have a lower interest rate, it makes sense for you to have your payment go down that much and shave off some interest. You certainly would want to look into something like that. And again, you want to be working with the lenders, keeping an eye on your file as well and saying, hey, I know they locked in it a little high. Let's see if we can, make it a better interest rate for them.
Right. So it's not free, but it costs less than the first time around, might be a couple $1,000. So let's just say, let's just say it's 3,000, or let's just say it's 2,400 for easy math. And the lower rate saves you $100 a month. It's going to take you 24 months to break even on that. So there's, again, the trade-off of how long are you going to stay in the house? Are you going to stay longer to make this worth your while? But the math could be better than that. Maybe you save $200 a month and then you get a payback in a year and then you're golden after that. So just something, I think always the how long are you going to be in the house is a good consideration for what you're willing to pay and rates and all that good stuff. But
I think that speaks to the discount points up front too. If you could get 6.125 today, but you really want 5.875, you can buy that rate down, but a good loan officer is going to tell you, look, you're only saving $13 a month. Is it worth buying down that rate today for $1,700? Let's see how long it would take for you to recoup that
right.
money. And so, you want to be making sure that someone's presenting you with all your options straight up. And when there are closing costs, do keep in mind that half of those are your own costs towards your own residential taxes and your own insurance.
Right.
Collecting it up front.
Yeah. So it's not it's kind of funny money a little bit, but could cost you some cash, but long-term, not extra money.
Now, recasting is different from refinancing, and not all lenders offer it. Let's say, Lisa, that you have your home in Fairlawn and you don't want to sell it just yet until you buy your new home in Ravenna, okay? And you're moving across town, family or whatever the reason is. So you have your own funds to buy this next home, but you haven't sold the previous home yet. When you do sell your previous home, after you move into the house on the other side of town, you're selling your home, you can take the proceeds from that home and you can put it toward the balance of your new home. So you can take, let's say you make $200,000 out of the previous home, you can put it toward the new loan. You do want to wait about 4 months for recasting. There are, different situations that are available to you. There's a small administration fee. It's like $250 or something like that. It's just a matter of doing some paperwork and putting that balance toward the new balance. So that's called recasting or a recast. And then refinancing is a little bit different. In that case, you want to make sure you're waiting 7 to 12 months before refinancing. And the reason to do this is because your credit score is based on several things. One of the biggest is the length of credit with each new creditor. Okay, so this could cost you 35 points, 50 points towards your credit if you try and pay something off and close an account less than the 7 to 12 months. 12 months is ideal for your own credit score. But if I went and opened a Target card and I just loved my Target card a little bit too much and decided I need to pay this thing off. If I pay it off and I close it under that 12 months, even 7 months in some cases, it's going to ding my credit. And like I said, sometimes 35 to 50 points. That is the biggest factor, is the length of time for each creditor. So you don't want to close that out, because it's really going to, you're going to cut off your nose to spite your face in that case.
Right.
But
Yeah.
every situation's different. And I do recommend, waiting to refinance until you're at least past your 7th month or your 6th payment. Because when you move into a house, you usually skip that first month's payment, and you're pay those 6 months and
And then you can refi.
6 months, 7 months really. But
Yeah.
there's that's the reason you'd want to do that waiting.
Right. And the recast, just to be clear, is not refinancing. So you don't get a different rate, but your monthly payment will go down, because it's basically like a recalculation. Like, okay, now you only owe this much on the loan divided by the months that are left. And then if you get it up enough, your PMI could go away as well, I'm assuming, if it's like conventional. So so that's a way to, if you have enough to maybe do the 3 or 5% down just to get into the house, but you don't want that monthly payment or to have to keep paying that PMI. Once you sell your existing home, you can put the proceeds down. And I guess if you came into some money or something otherwise, it doesn't necessarily have to be from selling a home, but that's typically what it is, right? That you could put money towards the house, and then it kind of recalculates your monthly payments going forward without changing the length of the loan or the rate of the loan. So.
Right.
Okay, well, we did it. A couple minutes left here. If anybody has any questions, this was really great information. I think you did a great job of explaining it in a way that people can understand, and like what to be thinking about, questions to ask, and how to best prepare for buying a home, and how to know what to expect of what it's going to cost them.
Yeah,
So
thanks for helping me walk through a webinar, and it's been really great kind of going through this information. Again, I know it's not the most exciting info in the world, but it's super important when you're ready to buy a house, isn't it?
Yeah, it really is good stuff.